we could see the Dow Jones fall back to that 3,000 mark, which is a 90% decline.
Most people, in the mainstream hearing this would say you're crazy. I mean, like, what? How can it fall that low?
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Steve St. Angelo, the host of the SRS Rocco Report. Steve, thank you so much for joining us today.
It's great to be here, Elijah. A lot of things happening, so there's plenty to talk about.
Definitely. Now, I'd like to start talking about the stock market, because you recently wrote an article about the recent correction we saw in the stock market, and you said that going back about 10 years, when we saw the crash of 2008, first we saw the Dow peak at around 14,100 points in 2007, and then it took 6 months before it actually fell off a cliff in 2008. So could this be what we're seeing today, kind of a repeat of that? As we saw the peak, I think it was in January of the stock market, it had this correction. It's still not going back above its old high. Is this kind of the inter-period, when we're seeing kind of this calm before the storm, maybe, or before we actually see the stock market fall off the cliff?
It could. The issue is, if we go back to 1987, the 1987 crash happened quite quickly. 25% was wiped off in just a few days. And several analysts are saying we could see the same thing. If we don't see that, then the second kind of pattern of the chart would be it doesn't go down in a straight line. So we would continue to see a correction, the market moving higher, maybe seeing another peak. It could surpass its 26,600 peak, and then we would see another correction. But again, if we go back to the crash of 2007 to 2009, it took a year and a quarter for the Dow Jones to peak from 14,100, and that was in October 2007. It took all the way to the first quarter of 2009 before it hit a bottom of 6,500, and that was more than a 50% decline. I think it's going to be even worse this time around. So yes, it really depends. I think the leverage now in the market is much more extreme, so we could see a much quicker sell-off. But if it doesn't happen, Elijah, it could happen over the next year and a half or longer.
Now, you've written that you think that the stock market is overvalued by 90%. Why do you think it's overvalued so much?
Well, it's based on my understanding of energy. And if you look at the long-term Dow Jones index chart, it was trading at about 4,000 points in 2005. Now, the U.S. increased oil production, or let's say energy consumption, a little bit from 95 to 99, but it peaked in 2007, but it didn't increase all that much. And matter of fact, total U.S. energy consumption is down from the peak in 2007, and it's about the same. It's in around that 99 to 100 trillion BTU. Now, the only way you could really increase GDP or net worth is if you increase energy consumption. And we saw this with China. During the 2000 period, the 2004, 5, 6, 7, 8 period, China was increasing energy consumption by double digits. Its GDP was increasing by double digits. And if we look at the world GDP over a long period of time, Elijah, it corresponds, the increase of the GDP is parallels the increase of U.S. oil, or let's say global oil consumption. So when we're adding more oil consumption, more oil production and consumption, the GDP will increase that percentage. So if you're seeing the market go from 4,000, the Dow Jones in 1995, to a high of 26,600, that is an increase of 6 times. We have not increased our energy consumption 6 times. So the problem is that is inflation. That is monetary inflation and has found its way into assets. So if inflation goes into assets, inflation can come out of assets. And my first level, which I call the first level we're going to reach, don't know when that level is going to hit, probably within the next 6 months to a year, is 18,000. The next level is the 200-month moving average, which is 13,000. And when U.S. energy production really starts to decline, and we could talk about that a bit, we could see the Dow Jones fall back to that 3,000 mark, which is a 90% decline. So that's where I see it heading. It's not going to happen this week, next month. It'll take some time, but that's where the ultimate fair value of the Dow Jones is.
Now, 3,000 for the Dow. I mean, that's more than half of what the previous low, back in 2009 of 6,000 something. I mean, that seems. I mean, most people, in the mainstream, hearing this would say you're crazy. I mean, like, what? How can it fall that low?
Well, it's interesting that we said the same thing in 2007 when the mainstream was going by the Federal Reserve. The Federal Reserve said, no, the mortgage industry, yes, there are some issues with the subprime, but the mortgage industry, the housing market is fine. No, that was false. It was horrible. We had liar loans. The whole industry crashed. The median home price went from $220,000 down to $150,000, and it would have continued to fall if the Federal Reserve and the U.S. Treasury and government didn't come in and backstop everything. So there's plenty of ample evidence that the U.S. government, the Federal Reserve, the U.S. Treasury have provided a positive market information, positive indicators, and they're flatly wrong. So the problem is, if we consider that the debt that has been coming in, we've got a quadrupling of debt actually since 1995, a quadrupling of debt. I don't know the figure. I know the figure for U.S. debt was 5.6 trillion in 2000. It's now over 20.7 trillion. So that's nearly a quadrupling in that period. So I would imagine from 95 to now, it's a quadrupling of debt. Well, when you quadruple debt, then you can also increase asset values. So this is why I see the value of the Dow falling. This is an unorthodox view. It's alternative, but I do believe we will get down to that level, especially when the U.S. shale oil industry really starts to disintegrate over the next several years.
Now, I know in one of your articles you talked about how really the stock market is in a bubble, but silver is not. Can you explain what happens if the stock market declines significantly, like you're saying, 90%? What will we see for silver and also gold?
When the Dow Jones, the oil price, and the precious metals and other commodities, they all went up together from like the 2002 period to 2007, 8. They all went up together. They all came down together. Silver was at $20. It fell down to a low about $9, and oil went from $147 down to $30. Dow Jones went from 14,000 down to 6,500. The difference now is that the Dow Jones, since the QE3, which was on September 2012, the QE3 and all the inflation has gone into stocks, bonds, and real estate. And in the last several years, the gold and silver price have been falling. Now, if we also look at the Commitment of Traders report, we can see that when the commercial short positions come to a low, fall to a low, the silver price bottoms. And we're starting to see that right now. And I show that in my newest video. So it looks as if the oil price, which is the leading indicator for the health of the market, it hit 66. It has a very high commercial net short position. It's topping. The Dow Jones is in the same situation with all the margin. So when we start to see a correction in the stock market or a crash, the oil price will go down with it. The opposite is going to happen with gold and silver, because we're going to see there's not many places really to protect wealth. And if oil prices are falling, stocks are falling, real estate prices are falling, we're going to see a movement of investors into the precious metals to protect wealth. And this already happened. The two biggest periods of record gold ETF flows were the first quarter of 2009, when the Dow was hitting its low, and the first quarter of 2016. And in 2016, it was surprising because even though it was only 385 tons of gold that went into gold ETFs during that first quarter of 2016 on a 2,000-point correction, it wasn't much more than when the Dow fell to 6,500 in 2009. It was like 450 tons. So what happens when we get a 30, 40, 50% correction this time? Investors realize that the market is very leveraged. So we will see a huge increase in demand for precious metals at that time.
So as for silver versus gold, which do you think will rise more?
What's interesting, the COT report for silver right now, and I'm discussing the COT report in the shorts. I believe when the energy predicament really starts the energy situation really starts to unravel, the commercials won't matter anymore. But now they still kind of they control the price, where the price of silver and gold are going to go, or they are an indicator of where the price and silver are. Right now, according to the COT structure, the commercial short positions in silver are at a low, which means the price is getting to a bottom. However, gold is different. Gold is still way off of its lows. I think the lows in the last year for gold were about 75,000 net commercial short positions. Well, right now, in this last COT report, it was 195,000. So even though gold is still a good precious metal, I think when the markets start to turn around and crash, we could see silver move up quicker. And we've noticed this in the past. During sell-offs, silver underperforms gold. And it's 80-1 right now. The gold to silver ratio is 80-1. We're seeing how silver is like off the radar. But when the markets crack and investors get into silver and gold, silver would outperform gold on the way up. And that's what it looks like, the setup we're starting to see already.
Now, as for the bond market, I'd like to discuss a little bit about that, because we saw the Fed minutes released recently, and it seems to be signaling again that there are more rate hikes coming. And also, we've seen on the 10-year Treasury yield, we've seen it increase. It's at a 4-year high right now. What is your perspective on the general state of the bond market right now?
Well, I listened to an interview by Charles Nenner on Greg Hunter, and he brought up an interesting thing. Now, while the bond market offers a safe haven when a stock market crashes, a lot of investors are invested in bond funds. Now, bond funds are different than a bond or a treasury, because you could not get your investment back. So we could see some issues when the markets start to unravel. But again, the bond market is usually the safe haven when the equities start to sell off. The problem is, if the U.S. government is going to raise interest rates, in just the last 5.5 months, they've raised the debt ceiling twice. I believe on September 7th, the debt was 19.84 trillion. They increased it on September 8th. It jumped up to like 20.2 trillion in a very short period of time. Then they increased it about a week ago. And now in just the last 5.5 months, Elijah, the U.S. debt has increased by 925 billion. Now, if we just go by the average interest rate that the Treasury is paying, it's 2.3%. At $1 trillion of extra debt, that's $23 billion more that they have to pay every year for the interest payment. But what's even more troubling is that the increase of the debt at 925 billion in just 5.5 months is the fastest rate I've ever seen. So the U.S. government is adding a lot more debt. The interest expense is increasing. If they continue to increase the interest rate, they're going to have to pay the debt is going to be, the interest expense is going to be even higher. So it's like a perfect storm. What's happened over the last 8-9 years is the prop up of a huge bubble, a much bigger bubble than that we had in 2008. And it looks like we're going to see a popping of that bubble over the next 2 years.
Now, what will that look like? I mean, what is your perspective on how people can prepare for this?
There is one wild card where they can come in and do another 2008 and just prop everything up. They can send U.S. citizens checks in the mail. We could see huge hyperinflation, and that's really the only last get out of jail free card they could offer. So if that happens, we could see the increase of the Dow Jones. We could see real estate prices going up for a while longer. We could see oil prices increase. But again, that's another Band-Aid to fix a problem that can't be fixed. However, let's say they can't pull that hyperinflation card. There's just way too much leverage in the market. I mean, the margin debt, the NYSE margin debt is the highest it's ever been. It's over 600 billion now. It was 450 billion at the peak in 2007 and 400 billion in 2000 at the tech boom. And if you look at all the indicators, they're still extremely in high leverage amounts. So they would become even higher. The PE ratios would become more absurd. So when the market finally crashes, I see deflation. That's what I see. I see deflation in copper prices, oil prices, real estate prices. I see the Dow Jones falling, heading towards the 18,000 to 13,000. And when this happens, there's so much debt and leverage in the system. People are living, paycheck to paycheck. Everyone's purchased things on payment plans. The whole thing starts to unravel. And the funny thing is people say, well, won't the oil price increase if there's less production? No, because when you have a huge deflationary period, Elijah, the issue is people will be out of work. They won't be able to afford, let's say, $1.50 gasoline. Even if it's that low, they won't be able to push the price up because in a deflationary period, in a collapsing debt period, there isn't the available money to push up the price of oil. And it's much more complicated than that. And I'm going to discuss that in future videos. But I do see a huge deflation and the very few assets to own to protect your wealth, and they will increase our gold and silver.
All right. Now, before we let you go, Steve, I was interested in discussing one last topic about cryptocurrencies. Now, the last time we had you on, you were talking about how there was a lot of fraud going on in the cryptocurrency space, and that was really what was propping up the cryptocurrencies, especially Bitcoin. Now, since then, we have seen, and you were calling for a correction, and we have seen that. We've seen Bitcoin fall more than 50%. It, went, I think it was below 6,000 for a little while, just briefly. And then now it's back up around 10, 11,000, something like that. Was this the crash you were thinking would happen, or do we still have further to fall?
This is the first step of the crash. And I think as the Dow Jones, nothing goes down in a straight line. And so the interesting thing with people who are very motivated or very passionate about the crypto market, I do agree with the blockchain technology. I think there's a lot of positive solutions that the technology can offer, but it's separate than the speculation that's taking place in the tokens, in the coins. The technology is one thing, and then the speculation is another. So even though this might not be a positive thing that many people who are invested in the markets, this is a typical bubble. Ripple, that went up from a fraction of a penny to $3.25, and now it's come down. It's now trading at 80 something cents. You look at that chart, that's a bubble. That's a typical bubble. Unfortunately, this bubble hasn't burst yet. When the bubble bursts, most of the crypto values will go back to where they came. And I believe, according to my associate, the next level for Bitcoin is like 4,700. So there's the other side, that you continue to hold on to Bitcoin, because in the future it's going to be the cryptocurrency that's going to make the present banking system obsolete. The problem is the banking system Bitcoin is not efficient enough to supplement or supplant the banking system. So you don't need Bitcoin does not function as it should. And so when we see the continued crash of the crypto market, there'll be less and less people enthused about it. And unfortunately, it's the technology that's important. It's not the speculation of these tokens or coins that's important. So yes, I do believe we're going to continue to see a continued sell-off of the crypto market. And 95% of these ICOs are going to disappear.
All right. Well, Steve St. Angelo, thank you so much for joining us today. Before we let you go, did you want to share with the viewers where they can find you and any last thoughts you had?
Yeah, thanks, Elijah. They can come to the SRS Rock Report website. I put out 2 or 3 articles a week, and now I just started a YouTube channel. And it's been about 1 a week. I'd like to do more, but there's 1 new video at the SRS Rocco Report YouTube channel, and I just put out a new video today. So if they'd like to check that out and subscribe, I believe there's a lot of good information. I'm going to continue to do updates on the markets, the precious metals, and energy. And we need to focus on the energy, because the energy is the driver of the economy and finance steers it. So energy is more important than finance. So that's how I look at it. And I will continue to put out these videos and explain these complex theories and analysis. It's much better to do that in a video. So I thank you again for the time.
Great. Thank you so much.